Give me a sense of how much, if CPI comes in as expected, how much does that move the general sentiment, do you think, for consumers across the nation?
I think it's a win-win for consumers. Certainly, when we look at our consumer confidence measure, consumers have been complaining about high prices and inflation, but those complaints have started to dwindle. And certainly, if you see that you go to the supermarket or you go to the gas station and it costs less to buy the things that you need as well as the things as you want, that means you have more purchasing power and the ability to spend on other items such as discretionary goods and services.
Dana, where are we seeing prices still elevated?
Well, we're definitely seeing prices elevated in the rental components of the CPI and also the PCE deflator, and also insurance. Many insurance carriers are raising the premiums for cars and also for homes. But I also see inflation lingering in other areas, especially services where you have to show up, such as hotels and restaurants, because of wage pressure, certainly because there's still labor shortages in some of those areas.
The interesting thing about insurance is that it is a reaction to what has been price inflation for materials and for labor. When you crash a car and it costs more to repair or replace that car, the car insurers take the hit, and then down the road, they try to go back and recoup their claims. And that's in part what we're seeing for insurance. But of course, if you have to pay it, it's noticeable in the price increases that you're seeing. When you're looking at those kinds of factors, do you think that there's a risk of reinflation?
Well, certainly there is a risk of reinflation if those insurance premiums continue to go up. But also when we look at the rental components, certainly existing home prices have already slowed, and that's filtering through to the data. But we've also seen existing home prices in the latest readings pick back up. So that could prove to be a problem late this year or even early next year. But we do think that certainly that slowing in the rental component will go a long way towards returning inflation gauges back to the Fed's 2% target. The question is, can they sustain it at 2%?
You mentioned the housing prices and the rental prices. When you look at what's happening on the labor front and what's happening on the wages front, we've seen unions make historic contracts for their benefits. How much pressure does that put on the whole picture?
It puts some pressure, but certainly when we look at union membership, it continues to fall. So it's not just that. A lot of it is the fact that you have labor shortages in key industries like healthcare, leisure, and hospitality. And across industries, many companies are hoarding labor. They're holding on to their workers. They may be reducing their hours, but they are raising their wages in order to attract and retain workers. And that's filtering through to the consumer price indexes.
I know that you have some concern over banks. What is it?
Well, certainly when we look at the small and medium-sized regional and commercial banks, many of them have extreme exposure to commercial real estate, especially to office space. We know office space is not doing well because of hybrid work. Many companies don't need as much real estate to accommodate workers. And so the values of office real estate are falling. And certainly we're seeing a number of the entities that are indebted not making good on their loans. And certainly that could wash back into the financial system if the banks that issued those loans come under pressure.
And do you think that we're in a holding pattern when it comes to the rates right now and where the Fed stands?
Indeed, we don't expect interest rates to start falling until June. The Fed has indicated that it's looking for more disinflationary readings so that they can feel confident that they can return to the 2% target sustainably. But once we hit June, we think that the Fed has room to cut interest rates 4 or 5 times this year and then maybe 4 or 5 times next year. But ultimately, the terminal Fed funds rate is probably going to be higher than what we experienced pre-pandemic.